and registered with the London Bullion Market Association. Our bars are accepted in London, Shanghai Gold Exchange, and also on COMEX.
Yeah, well, that's the important thing. You've got all the important accreditations. So you're not some backwater refinery operating out here on the East Coast, are you?
No.
All right. Now, the reason why I wanted to speak with you today is because you have extensive gold experience. I mean, you've been working in the gold markets in Australia for 25 years, I believe.
Yeah, 25. It gives away my age, but anyway.
All right, so let's kick off today. Now, just before you and I jumped online, we were talking about the recent surge in investment in retail demand. Now, you and I really do want to get down into what happened in March, just gone, but I want to talk about this second wave of physical bullion demand that you're seeing come through right now.
Yeah, it's look, obviously all retailers across the globe were hit quite hard with COVID, and that just created a massive surge in investment. So for us, we saw about 3 to 4 times our normal volume was the sort of uptake. And it tapered off, obviously, after that initial lockdowns across the globe. And then what we've seen over the last probably 3 weeks, I think, it started to build again. That wasn't necessarily COVID related. It was probably a little bit more about just uncertainty of what's going on financially and the impact of COVID would have economically. And then obviously in Australia specifically, we've seen a real second wave, both of coronavirus for you down there, Shae, in Melbourne. And those lockdowns that have happened down in Victoria have caused retail investors here in Australia to become, again, super aware of both the impact of COVID on the economy, as well as the economic impact, I suppose, and its impact on gold prices. And then this week has just been crazy because the gold price has surged up, and we've seen people, triggering them to go, I've been thinking about buying gold, and then the price moves, lockdowns happen, and they're basically wanting to get in quickly.
Well, actually, I'm really glad you mentioned that. So we've got gold in US dollar terms over $1,800 right now. Now, back in October last year, you and I had a completely separate conversation where we were talking about how people tend to wait until gold's in the headlines and then they start going to buy it.
Yep.
And then March came and nobody could get their hands on a bar for love nor money. So let's talk about how retail investors, we'll get to institutional investors in a second. Let's talk about how retail investors, in that instance, regrettably left it until it was a little bit too late.
Yeah, I mean, it's something that I suppose, Amazon makes it so easy for people to buy a pair of shoes. And you know that if you log on, you're going to be able to get those pair of shoes. It's always in stock. The concept of running out of something in a consumer environment for normal goods is just not there. So people's, I suppose, expectations of precious metals is the same. I can log on anytime and buy it. But the reality is that there's a lot of refining capacity, but the production capacity to melt bar down into small bars. So to give you an example, the international traded size is 400 ounces. Mm-hmm. So it's a lot easier for a refinery like us to make one 400 ounce bar than it is to pour out 400 1 ounce little bars. And so if we have demand from an institution that wants to buy a 400 ounce bar, great, that's one gold pouring. If we have 400 retail clients that want to buy a 1 ounce bar, that's 400 extra, effective process steps. And so in industry globally, that extra production capacity, the level of capacity to handle retail volume is a lot less than it is to handle that bulk refining institutional level sort of market. And so we saw this in 2008 in the global financial crisis. Again, mints went into limited production capacity. They all got bought out. Delivery delays went out to 2 months or more. And we saw the same thing happen again with COVID, because there is only so much production capacity to mint coins and small bars. And it ends up where premiums start to surge. And so the end price the consumer pays is going up. But the gold price probably a lot more than the gold price does. So it's something that, investors, I suppose, if you're leaving it to the last minute, you can end up getting caught out. The mitigating thing for that is that products like ETFs have made it easier for the industry as a to handle the volume, because every person that buys an ETF is probably, that is buying 400 ounce bars. So the sort of ETFs have probably made it a little bit easier. I think if there weren't any ETFs, we would see absolute complete lockup in terms of physical precious metals.
So arguably people were we're sticking to the retail investor side of it for the moment. So what you're pointing out is thanks to basically being able to paper trade gold via ETFs, people could get price exposure that way, but they couldn't get their hands on the physical metal. And I know this myself because I had some orders in and I wasn't getting delivered either. Now, I want to talk about, the March mayhem, and I know that sounds a little bit hyperbolic, but that's really what it was. I mean, we looked at Swiss refineries shutting down. We're looking at planes that couldn't get the gold from Africa to the Swiss refineries to get it to COMEX. These are major, major events, and it really pointed out how interdependent the gold markets are, and also, too, how easily that chain is broken. So Australia, on the other hand, didn't have those problems happen. So let's compare what happened in the Northern Hemisphere then versus what happened in the Southern Hemisphere before we get onto arbitrage opportunities.
Yeah, so look, Australia in that sense was lucky because we are an island sort of nation that, once the lockdowns come in, I suppose the flights in and out and it's a smaller population here, so we don't have as much density. So the two refineries here, ourselves, ABC refinery, as well as Perth Mint, were still able to operate. But the Swiss refineries that you mentioned, the three main ones, are actually just north of the Italian border. And the historical reason for that is that those refineries would supply the Italian jewellery industry. And so part of the problem for the Swiss refineries was that a lot of their workers are actually Italians that come over the border. And obviously we knew that COVID hit Italy quite hard. So they were told to lock down and completely shut down at one stage because of the severity there. And so, yeah, that really impacted quite significant because they are a crucial link in terms of transforming London metal into forms that are probably a little bit more suitable for the US market as well as the Asian market, whereas Australian refineries like us, because of our geographical location down here, our gold output tends to flow to the Asian market directly. So yeah, it does create a real problem because the gold market prior to this really does rely on smooth logistics to get the gold from the major producers. And Australia is the number 2 global producer, just behind China, to get that gold out, distributed to where it needs to go. And so COVID, with the fact that those planes were all basically completely shut, I mean, you're sitting here, everyone's sort of going, well, how do I move this gold around? So we saw this really interesting situation where prices started to dislocate. It was really unprecedented.
It was, and it also, I think, pointed out the fragility of the supply chains, which we'd never seen before. I mean, again, you bring up the Amazon example where we click a button and we get things delivered to us when we want. I mean, I can buy and trade shares, not Shaes, in minutes. So the idea of having to wait and not have something be accessible is really foreign to us. Now, before I move on to my next question, I'm just going to let everybody know who's listening. Don't be afraid to submit your questions in the chat. That's the whole idea of today, is that we can, ask a gold expert who understands how the markets move. All right, now, before we start taking questions from people listening, let's talk about the enormous net inflows of gold directly into the US. I believe we've got a handy chart somewhere. We've got our everything guru, Daniel, on the line, who's going to make that happen on the screen somehow. So when it appears, you'll be able to see what Bron's talking about. But let's kick off, Bron. You mentioned before that there's been this enormous rise of tonnage of gold going into the US in a very short space of time.
Yeah, it really, I mean, the chart that we've got here, which just shows net import exports, and in this case for the whole year, annual ones, and it goes back quite a long time. And what you see is that pretty much America is a net exporter of around, say, 200 tons a year, and that's because it itself is a gold producer. It mines gold, and it also imports gold from South America. The refineries there in the US process it. Any gold that's needed on COMEX or for domestic use in the US Mint and local sort of consumption, and then the excess is exported out. But you can see on the chart what we've saw, and this is just really for the 6 months for this year, so it's only 6 months, not an annual figures. It's 250 tons importation. So that's a change, a net change, really moving from a export of 200 to importing 250. That's 450 tonnes that is basically reversing or changing. And it's quite a significant change. There's a number of things driving that. I mean, obviously, the primary thing is that Americans want to buy gold, and it obviously is the key. And I think that flow has actually been happening probably through 2019. What we've seen is a lot of the smarter money has been coming in. It's not really a retail phenomenon. But then COVID hits, and at the same time, so you've got COVID where it restricts those supply chains and that freighting, at the same time as investment demand in the US, be it through COMEX or ETFs, takes off. And so, and it's probably a bit hard to understand, but you see it in other markets like China, for example. In China, because there is actually a legal restriction on exporting of gold, they can bring it in, but they can't take it out. If there's no demand in the country, the price starts to, obviously in a local supply and demand balance, if you've got too much supply and not enough demand, the price starts dropping. And so there is common in, say, China, if you compare the Chinese local price to the London price or the global price, it sometimes trades at a discount because you can't get it out of the country. So there's excess in that location. And the same thing happened in the US. And I suppose I should back up. It doesn't normally happen in any of the markets. So the Australian gold price, the price in London and the price in New York, for example, are generally all quite close. There is a slight difference because it costs some freighting to ship gold from Australia to New York, for example, or from London to New York. So you'll see a slight difference, but the role of a bullion bank and other hedge funds and arbitrage traders is basically to see if there's too much demand or supply in one or other locations. They buy it in the cheaper location and they sell it in the more expensive location. And it's not normally visible to the average person because we're talking about 20 cents, $1, you know, on top of a $1,800 gold price. No one really notices that difference. But what happened, because the flights were restricted and so no one could move gold around, you had this surging demand in the US, but the supply was restricted. And so obviously, basic 101, what happens? Price goes up. And so the pricing of COMEX, the price for gold in the US, started to diverge and rise well above what it was trading in other markets. And that's really unprecedented. And it actually, look at, you know, it was initially, you could say that it was driven by the flights, but the flights have started to open back up. But we still see a pretty elevated gap at times. And I think the other factor, which is not really talked about too much, is that it does indicate that the banks themselves have got funding issues. It's like a flag to say, hey, there's a little bit of a funding issue. Because to do that arbitrage, to say, okay, I'm going to buy gold over here and I'm going to ship it in to another location, well, you've got to borrow the money, or you've got to tie up your funds for the time period that it takes to get the gold into the new location. And so even though the arbitrage, even though the gap would have been 20 to 30, 40, $50 an ounce profit that could be made by just buying it in London and shipping it to New York. The fact is that I think banks had a restriction on their positions and a restriction on their funding to say, look, we can't really tie up money on that trade. And it was starting to become quite a long time to tie it up because it had to get into the refineries, to be reprocessed, to shipped in. Flights might have taken longer because they were restricted. So a lot of factors coming into play, and it just really highlights how the market relies on these arbitrageurs and the smooth functioning of logistics to actually keep everyone together in terms of price.
What does that mean for the arbitrage opportunities going forward, though? I mean, we've basically, you know, found a flaw in the matrix, so to speak. So does that mean that they'll be, you know, that we've been able to paper over them, or that now that the markets are more aware of it, so they're going to seek out that sort of opportunity going forward?
I think we're going to see, look, the flights have sort of started to come back, and so the capacity to move metal around is there. But I think we're going to see a little bit more of this dislocation happen from time to time. It won't get to be a $70 price difference like it was, you know, at the peak of this. But I think we will see periods where if demand, say in the US, is starting to surge and either people are buying ETFs or COMEX futures contracts, that pushes the price up, but then arbitrageurs particularly if there's still funding issues and dollar liquidity restraints, not as many may be stepping in, and so that gap will sort of surge up. And you have seen, if you look at those in the trade that look at this price difference between New York and London, they have observed that sometimes it sort of opens up and then the gap closes back down, and it's opening up usually when the price goes up because people are buying. So there's a surge in buying, and then the market's taking a little bit more time to react to that. And the reason for that is that one of the mechanisms is that there was a lot of the arbitrage to keep these prices together. There's actually a lot of paper-based trading, and it's now relying on actually having to deliver physical into COMEX to settle the contract as the way of closing out that arbitrage. Whereas before, the market was sort of relying on traders and the other side of the market being long, that they'd say rolling a contract forward rather than standing for delivery. It's now a lot more physical. So that's why we're starting to see a little bit more pressure.
What sort of cost is that going to add, though, if COMEX is going to have bars for delivery now? Because they never used to. They've always kept them over in the UK, haven't they?
Yeah, in a sense, the paper trading between London and New York has allowed London to sort of become a warehouse of COMEX in a way. So you've got physical metal in the US, but the fact that you can trade between London and New York has allowed the London market to effectively act as a backstop. But when the market becomes more physical and people are a lot more worried about risk exposures and the liquidity and the lack of liquidity, where it might suddenly shrink, then traders are more likely to say, well, rather than holding a paper position where I'm, say, short in COMEX and I'm long in London, I actually need to get that metal and deliver it into New York so that I can settle my contract in physical. And that obviously adds a bit more of a friction. So yeah, I think that's going to be a continuing feature. It hopefully will only end up being more of a smaller amount of dollars and not $70 price difference, which I think is quite embarrassing, to be honest, to the industry and the players in the industry that it got that wide. But I think it'll be sort of a little bit more under control, but I think we will still see stresses from time to time.
Now, with all of that gold flowing into the US, obviously some of it went into COMEX. Now, what about, where else is all this sudden gold import in the US going to? Who's gobbling it up?
Look, for the US, we are seeing, I think it's institutional at this stage. I mean, I think from mid-2019 when the price really moved, at least on my view, it was not really retail driven as much. It was a lot more of the smart money and institutional sort of investors that were buying it. And we are now starting to see the retail investor come in. So it's a lot more institutional buying that was occurring earlier.
Now, you've got quite a diverse group of clients. You've mentioned before that you've been speaking with some of your high net worth clients in the US that are struggling to get their hands on the physical precious metal themselves in the US. How do you go about filling those supply gaps from Australia?
Well, look, in some cases, we've had some sort of pretty high net wealth clients that are actually coming direct and buying, and they're wanting to keep it in Australia because it is a bit of a geographical diversification thing. So they're wanting it offshore. But yeah, there has been situations where we're working with counterparties to get metal into New York to take advantage of that sort of arbitrage and keep the market functioning. But yeah, it's mostly been institutional today.
What sort of premiums are you seeing across metals in general? I mean, we'll talk about the gold silver ratio in a minute because that's starting to come down again as well. But what sort of premiums are you seeing people willing to pay just to, get delivery on goods?
Look, it's hard to say because it's been such a dynamic market. And yeah, it's quite difficult. Right now, it's not significant. It's not massive. But yeah, it's really very hard because you've got to factor in what's the freight situation at that point in time. And even now, it's still a bit sort of uncertain. I mean, we've had situations where, flights have been booked to move metal and then the metal gets kicked off the flight because they've got masks, medical sort of takes a priority. So, yeah, it makes it hard to sort of commit to trade sometime. But yeah, the premiums have been elevated. Interesting though, in Asia, the market's not very strong. So the premiums for kilo bars in Asia are actually, quite low. because that market is not really functioning as well. And also the price is high and Asians like to buy cheap.
Actually,
it will come back eventually.
Actually, that is a great point to touch on, because there's a cultural difference here, especially with Western markets. You know, we see the price going high, and we tend to see more demand. But as you've just pointed out, that in Asia, no, they see the price going high and they pull away.
Yeah, yeah. And so, yeah, it's been that way. There's been a bit of scrap coming out of Thailand. We have seen some scrap flows. The COVID has obviously restricted things there a little bit as well in terms of the physical market. But yeah, I think the general increasing of the price from 2019 to now has sort of caused that market to sort of be moderate and quite low in demand for a number of months. And so, yeah, it's been fortunate, to be honest, because the lack of demand out of Asia, which is the natural buyer and has been the natural buyer for many years, that has actually sort of given the Western markets a bit of breathing space, because if China and Asia generally was buying gold in the quantities that it was, plus we had the Western demand as well, yeah, I mean, who knows where? I mean, the price would have definitely been over $2,000 an ounce well before, months ago.
All right, let's talk a couple of pie in the sky ideas. Where is the price of gold going? I mean, I've got my own views, and some people love to throw out crazy sums. Do you have a short-term forecast of where the US dollar price is going?
Look, I might have had a view before.
Sorry to throw you on the spot.
I thought I thought 1850 or 1870 might have been quite aggressive, and it's just been quite dramatic. And it's actually interesting because, look, my view of it, and if you look at the experience of the bull market up to the financial crisis and after that up to 2011, is it's a really step market. So you see surges and the price sort of backs off, investors sort of, take a breather, and then it surges again. And so that would be my expectation. And this may be just one of those surges that we're seeing right now. It's not unusual to expect it to back down. I wouldn't be surprised to see it come back to 1800 from where it is. But yeah, it will be grinding its way up to that all-time high. That's going to be the crucial level. As you said about headlines, there is very much a sort of FOMO, fear of missing out, and it does create a positive feedback loop, because it's those headlines in the mainstream media that drive new buyers to get their attention to think about gold. And what media like are all-time high. And so when it breaks 1920, we will see a flood of mainstream media coverage saying gold has broken all new time highs. And this will be interesting news for mainstream investors who've never even thought about gold and barely pay attention to it. They'll go, oh, the gold price is going up. Well, it's been going up since 2016, but they'll suddenly become aware of it. And that is going to drive. So I would see a real kick up if it can get through and hold that level. We'll see a real kick from that point on. And I think once it gets through 1920, 2000 will probably be a lot closer and a lot quicker from there. But it may take us some time to get to that point here. But having said that, this recent surge to 1870s and so on in the last few days, on the back of obviously this sort of US-China tensions and the European stimulus, and then the issues of governments having to continue their stimulus because of COVID, obviously has driven a lot of money flow into gold as a concern about what the inflationary impact is of that sort of stimulus and money printing. So it may well continue on, but I think it's this initial sort of surge. It'll probably come off a little bit from here.
I actually would argue that you've just put forward a key level for everybody to look at to make sure they've got their physical gold in their hand before the price hits that.
Yes.
And again, this is what happens with that high prices drives interest. And if you want to, have it in your hands on the day it hits that price, you need to get your order in before then. But also too, the higher it goes, and this is just for anybody, I know obviously if everybody's part of the Sprott Conference, chances are they have an interest in precious metals anyway. But if you would like to avoid paying higher premiums at a time of high demand, I would have your eye on the prize and making sure you put any bullion orders in with any bullion dealer before it hits that $1,900 mark.
Yeah, absolutely. And I mean, the other thing as well, it's interesting. I mean, we're at the Sprott Conference, so I just went and had a look at the Sprott Physical Trusts. And they're also an interesting option because you can see that they sometimes trade at a little bit of a discount to their net asset value. And when particularly, look, if you look down in 2016, you can see at the bottom there, that they were trading at a little bit of a discount, I think maybe 5% if I remember correctly. So you could, if you're buying something like that Sprott Trust, you can actually get the gold at a 5% discount. And then when the demand comes in, it will trade at a little bit of a premium. So you'll get the upside in the price, plus you'll get the upside in the fact that it's diverted back to its net asset value. So that's also another way to play it. But yeah, if you want to get the physical in your hand, it's advisable to get it now. After it breaks that all-time high, yes, we are going to see retail investment come through again at another wave, and that's going to, again, suck up all that production capacity. So I just hope that, you know, there'll be a little bit of a lull so that we can, as a refinery, we can get back and build up some stock levels. But yeah, hopefully we have the chance to.
Well, I actually know, because during March, when everybody was trying to get their hands on precious metals, I was speaking to one of your traders, and he said there was just, you know, the machines can run almost 24/7, like, because you've got a fully automated processing plant.
Machine, yeah.
What was it? What did you call it?
Just a barring machine, yeah.
Barring machine. Okay, I probably should have learnt the technical name before we started. But you've got a fully automated process. So you're talking about robots that are, and I've seen these machines in action, doing it almost 24 hours a day. And yet the robot still couldn't keep up with demand. That is how intense demand was. And we could also, just for some context, argue that Australia isn't really very knowledgeable when it comes to the benefits of physical gold ownership, are we?
No, Australia is not like the US. The US, I think in general, the population's got a lot more awareness of gold, a higher sort of propensity for it. It's not as common in Australia. So yeah, certainly that's a factor in Australia. I think once people trigger into it, there's potential for quite a big surge.
Do you think the US have a better understanding of gold because of the Roosevelt legislation where they barred gold ownership compared to Australia?
Look, certainly I think that's a factor, because obviously you've got that sort of generational stories that are told from, you know, the grandparent down to the grandchild about that. But I think it's also reflective of the fact that the US being the sort of dominant monetary, US dollar being the dominant sort of currency, and the fact that it was gold backed and then it went off the gold standard in 71, all of those factors, obviously being such a central currency, means that within the local sort of that country, obviously its awareness of the US dollar, its role, and the role of gold within that, I think is a lot higher than a country like Australia, which is, you know, its currency is not as globally recognised. It's still we trade well above our economy size in terms of the currency traded on international markets. But yeah, so it's not as common in a lot of other countries. And yeah, look at Germany, again, gold ownership and awareness is quite high there, you know, because of the war and the situation that they had as well. So it does come down to that history.
All right, we've got some great questions coming through, Bron, so we're going to move on to them. The first one is Ken. Hi, Ken. Thanks for joining us. Now, Ken would like us to discuss net central bank buying over the last 6 to 12 months. He wants to know who are the biggest central bank buyers in this calendar year, and is the Chinese government a net buyer in global markets, paper and or bullion in the last 12 months? So this is quite a meaty central bank question.
Yeah, look, well, actually, China's come off quite a bit. They were quite significant. And I think it's been interesting because the headlines around central bank buying have been, you know, central banks have been buying hundreds and hundreds of tons. They've shifted to net buyers, not net sellers. And so when you look at the aggregate numbers, it's quite significant. The actual fact is that it's quite limited in terms of who's been buying. So, you know, countries like Kazakhstan and China obviously have been buyers. You've got Turkey, but it's not broad-based. It's not been a broad-based buying level. But having said that, what's interesting, and I did do an analysis of this, and unfortunately I haven't got the chart to bring up, but what we saw was that those sort of countries like Russia, China, which is not surprising, that they're looking to sort of de-dollarize, right, or to get an alternative reserve asset. So they have been accumulating gold, and that's not surprising. And whilst it's not massively broad-based in terms of being like 50 different central banks all accumulating massive amounts of gold, what's interesting is that the Western central banks, the major banks that were sellers, all completely stopped. And the interesting inflection point, when did they all suddenly stop selling? Global financial crisis, 2008. And I think that tells you something, that the central banks themselves, that financial crisis freaked them out. And they stopped selling gold. okay, maybe some of them weren't willing to start adding and accumulating, except people like Russia and China who probably realized, wait a minute, can I get knocked out of the SWIFT financial system? What's my alternative, means of settlement? They've come in, but certainly the other Western central banks have all stopped selling. And that's quite significant. And it's funny that, don't listen to what someone says, listen to what they do. And if you look at what central banks are doing, they aren't selling.
So not only have central banks been accumulating gold significantly in recent years, but they stopped selling a decade ago, which was long before gold went on to hit a brand new high.
Yeah.
A very powerful move. All right, our next question is coming from Nicholas. So we're going to start with, there's quite some detail here, so we might break it down into a couple of parts. So Nicholas would like to know, a lot of people talk about COMEX being inherently bad as it manipulates the precious metals markets for the benefit of large financial institutions. Or is it more of a neutral tool?
Look, you know what, it's funny because in a lot of the, I suppose, gold commentary, you do have people that sort of speak ill of the COMEX, and particularly around, I suppose, the excessive speculation that goes on in that market. And in some sense, there's a subtext to that to say that it's an unfair market, it should be shut down or restricted or controlled. It's in those sort of views, I suppose, in a little bit of contradiction to a more libertarian view, which is, well, if that's the market, that's the market. The thing about it is that whatever happens on COMEX, and certainly we have seen a lot of cases where there's been manipulation of the price, and these are trader games, right? We're spoofing trades, and obviously there are a number of people that are under investigation right now for putting spoofing trades through. It's a little bit different to the concept of suppressing the price, which is a long-term, ongoing, massive sort of thing. So temporarily, in short terms, you can have games played in markets where the price may be pushed down. And to be honest, if you look at some of these trader tapes and the conversations they have, they also push the price up. But to suppress the price on an ongoing basis for decades or years and years, you ultimately need physical metal. No matter how much paper trading is going on, to suppress the market, which is a global market, you have to be supplying physical. And I have seen, so that has been a speculation. And obviously one of the speculations is that the central banks are surreptitiously sort of supplying into the market. The fact is, even if you look at some of those analyses, the central banks would have all run out of physical by now, because the amount of physical that's being sucked into the Asian markets, which is a one-way channel. So I don't think that there's sort of a case to say that the price has been massively suppressed over decades. If it has, then the physicals run out. I think what the nature of COMEX is that you have speculators, and speculators don't want to put up, the full money. They want to put up 10% margin, and they want to have magnified leverage gains. And that's a segment of the market. And the other side of that is that a bullion bank or a market maker will come in and take the other side of that trade and hedge it off. Is that inherently bad or not? Look, I think a speculator is a speculator. You can't sort of stop people from speculating. If you shut down the COMEX market and said it's an evil market and should be shut down, then as a speculator, what do? I go to a bank and say, look, can I borrow some money off you to buy gold, and I'll give you the gold as collateral. The bank will do that trade. I mean, you could do that trade privately where someone would say, okay, well, I'll lend you. And then all you need to do is provide, again, a 10% margin to cover the change in the price. But as long as the lender of the cash holds the gold as collateral, they're only interested in the change between your loan value and the gold price. So you can't stop leverage and speculation because it's a free market phenomenon. I want to go to someone and borrow money and buy gold and leverage it. How can you stop that? COMEX is just reflecting that. And so what we see is this general attitude. And I think what I'd say is that the amount of speculative volume versus real physical hedging going on and physical settlements by industry in COMEX, certainly the speculation has become excessive. But that's reflecting, I think, a general whole change in the way investors have been approaching all markets, not just precious metals. We see that with Tesla's price. We see that with tech prices. We see that with these crazy price earning ratios. The market has moved away from value investing. What is this company? What does it make? What's its long-term output? How much profit will it make? What dividends will it pay me? And then working out a share price to effectively momentum and, sentiment. And that's infected, that sort of speculative or gambling type approach has infected equities, and it's no surprise that it infects precious metals. And we just see that manifested in the way that COMEX trades and the amount of volume on COMEX.
Now, I skipped a subject before that I wanted to come back to before we move to the questions. Have a sip of water. And I believe there's been some internet issues for some people. I do apologise. We are very far away from the other side of the world. I wanted to touch on the gold and silver ratio before. Now, I actually haven't checked where it was this morning. I probably should have. But obviously, for a long period of time, silver has actually been underperforming gold, by its values being quite low. What are you seeing changing from your end? And are you seeing investor interest pick up in silver as gold rallies?
Yeah, no, we have seen a definite switch. Let's say an increase in the proportion of money flow going to silver. And I think investors have looked at that ratio, which got up to 120, 130, which is just crazy. And that was purely a COVID-driven thing because it was looking at silver's industrial demand being decimated because of COVID restrictions. But yeah, it was excessive, even at 100-to-1 ratio, it was excessive. It's now back down into the 80s, which is a lot more realistic. But historically, 80 is still massively way too high. It normally trades on decade levels from sort of 40 to 80. So even at 80, it's still quite high. I think it'll take time for silver to breathe while it catches up to gold and consolidate. But yes, I think it would be to expect silver to sort of outperform again and get that ratio down to the 60 level, which would be a lot more realistic, I think.
Well, that's the thing with silver, and that's where it's quite tricky. It's a slow catch up, but when it catches up, it's this enormous rally that you say you don't see coming, but it was, you've got to be prepared for the rally, don't you?
Yeah. I mean, look, you have to factor in that industrial component. Silver is circa 50% industrial demand. So industrial provides that nice base demand for silver. In times like COVID, it obviously disappears and that causes the price to languish. But then on the upside, if you've got sort of green technology, solar, that can put a little bit of a kicker into silver. But it's really that investor demand that comes in that causes those surges because the industrial demand is quite consistent and a good solid base for silver. It's that investment demand that causes those surges because it's a lot smaller market than gold. So the money flow in there can really make the moves quite significant.
I actually like that little kicker that you put in there, that silver is also part of green technology, and obviously being a resources symposium, that's kind of crucial. So the other way people can access silver is by looking at green technology investments, and obviously silver ETFs. All right, we're going to wrap up in the next few minutes. So if anybody's got any further questions, try and pop them through. I am really, really sorry that we've had some technical issues. Before we go forward, what have we not covered today, Bron? I mean, we talked about the arbitrage opportunity. Do you know what we didn't get to? How it exposed the banking weakness in March when the gold markets basically showed their fragility. We didn't quite get to the bank's weakness there. So can you cover that off for me, please?
Yeah, look, I think a lot of the trading, I think this is the thing to sort of people, the arbitrage that happens because it's at the institutional level, and it's not even at the institutional level, it's purely sort of within the trade between bullion banks. It's not something that's obviously understood and spoken about. And there's a lot of that arbitrage was paper trading. Yep. So, and the interesting thing is that the arbitrageurs are trading the gap, the change in the gap between London and New York, not the price, which is sometimes a hard concept to get around. Because what they're doing is they are, say, selling a futures contract up here, and then they're buying the spot physical gold down here. And that gap is their profit. And then what they were trading is this gap, because as the futures contract comes to maturity, this gap tightens. And then sometimes it can surge and open, so it has a little bit of space. So the price may be going up and down, but there's also the gap between markets that it trades. And so a lot of these arbitrage traders are trading this gap. Is this gap going to compress or expand? And what they're relying on is other players like bullion banks that have the ability to deliver physical in to effectively backstop those arbitrage trades. And so they rely on that they can trade at paper. Now, what happened in COVID is that a lot of positions, and you've got to think about it from a bank, the bank risk manager looks at this trade and says, okay, I can see that you're short in the futures market and you've got a physical position in London, but the prices are different. So there's a loss on that trade. If they locked in at this gap and the gap blows out to this way, that's a loss for someone who's short that trade, which is what they call short the EFP is the technical term. So what happened is risk managers would go to that trader and say, you've got a big loss, and they have to book that loss. And obviously, as you're a trader, if you start to have a book losses, your ability to trade is restricted. And the only way that you can sort of tell the risk manager to go away is to actually say, no, what I've got is now physical in New York against my short contract. So those two things will close out. And then the risk manager will say, okay, the gap is not going to be a risk to you because you've got the physical and you're going to close the futures trade. But obviously, if COVID restricting deliveries, it's not possible for paper traders to actually turn their paper trade into a physical hedged trade. And that obviously resulted in them having to buy back their position, which provided further fuel to pushing the price up because they're having to buy back their futures contract. They're short buying the futures,
Yep.
so they're pushing the futures price even more. So yeah, it really shows the fragility, I suppose, not just logistic issues, but also the fact that the market relies a lot of paper trading to achieve its sort of ends and to maintain that connection. And then, as I said before, underpinning that also is access to finance. It's access to, think about it, I'm a trader in a bullion bank in the bullion division. I've got to compete within the company for funding for my positions because there's someone who trades equities, there's someone who trades bonds, and they are all looking to absorb the capital of the bank to say, give me the money to put this trade on. And so, when the bank compresses its restrictions because it's got a euro-dollar problem, there's liquidity issues elsewhere, then its whole pool of funding restricts so that it can give to traders. And in some sense, I suppose the gold trade probably wasn't as highly profitable, even though it was profitable, it was not as profitable as what the bank needed the money for something else. And that gives us a little hint, okay, the banks are a little bit under stress because why would you leave a $70 an ounce pure profit? Okay, there was cost in moving it, but that is a large amount of money per ounce to make. Would you leave that on the table? Why did that gap persist? Mm-hmm. Obviously, logistics are one aspect, but bank access to funding and ability to fund that position and fund that arbitrage trade was obviously compromised.
All right, so we've got a couple more questions come through, so we'll run through these and then we will get close to wrapping up. First of all, a question from Bo. He's never quite understood how gold and silver prices can be manipulated by someone. Can you walk us through the details on how this theory of manipulation works?
Well, as I said, traders will play games, and they've been called out recently, where they do try to psych each other out, okay? And I know that can get a bit of a negative sort of view, but I think about it, when you go to buy a car from the car dealer, you don't reveal your hand. You don't tell him whether you're really desperate to buy this car or you much rather prefer that other model in another lot. And he's obviously not going to tell you how many sales he's made and whether he's reached his sales target or not and whether he's really desperate to sell the car. So you basically are both lying to each other about how much you really do or don't want to buy or sell that car. And traders are no different. So when they're playing that game of trading, they are trying to spoof and pretend. And then the other dynamic that's kicked in, that I suppose driven them maybe a little bit beyond into a more ethical grey area, is obviously high frequency trading. And if you're a manual trader and you're trading against a machine, obviously then the temptation is to put spoof trades in to try and give you a level playing field with a computer. The temptation is to step out. So those sort of manipulations where you would put a trade on, you'd have a sell trade in the market and you'd have buy trades and maybe more buy trades, and then to indicate that maybe there's more buying demand than there really is. And then before they get hit, you pull all those trades off. I mean, there's all sorts of techniques that traders can use to create that sort of manipulation in a market, but those tend to be very transitory. They tend to be very short-term intraday trades, really. It's a lot harder to sustain a position like that over many days, months or years. And that's why I said earlier, to get the concept that the gold market's been suppressed well below its fair value, you have to ultimately, because the Asian market has been sucking gold out consistently, if you want to keep that price down, you've had to be supplying physical. There's a lot of paper trading, but there's a lot of physical that goes underneath that. And so you can't suppress the price just with paper. Because, I mean, look, sure, I suppose, a government entity could come into the futures market with unlimited sort of funding and go and sell massive amounts of futures contracts. But if the gold price gets pushed down to $500, what's going to happen? everyone in Asia is just going to jump on, and they'll say, okay, well, if that's the price, the real price of gold, great, I'll have as much as I want. They want physical, and that will get fed back in. So you can't really ultimately suppress the price below what the physical market really thinks is the fair value. So I'm not a fan of the suppression. I don't think there's a case for an ongoing suppression, but that's not to say that you don't have these short-term manipulations that are played by traders.
That's a great answer. Now, before I move on to the next question, Nicholas has just said, thank you very much for answering both parts of my question. Very enlightening. All right, we're going to move on to Ken now. He would like to know what role may central bank gold holdings have 5 years, hence as we work globally through the consequences of massive, widespread quantitative easing. Any role, any possible role for a new gold standard in the future?
Yeah, well, the key question. Look, I don't know. I do follow some very pro-gold economists. George Selgin's a good one, George Mason University. You know, he's pro-gold, but he's not sure that we can ever get back to a gold standard. And he makes the distinguishing between what would you call a price-fixing gold standard, where the central bank sort of fixes the price of gold and says, this is what it's going to be, and I stand in the market to buy or sell. He says those sorts of, and that's a perception that what the gold standard is, that's not going to be sustainable. Central price fixing was not going to last. You know, arbitrageurs will come in, the people will play that. They will basically break that peg if you try and peg something. A true gold standard is something where you're just denominating gold and allowing it to trade freely, and allowing it, I think the key is obviously to remove capital gains tax off gold so that it trades open market, and then allowing that and defining prices merely in ounces, not so much in dollars. The market still has to operate, the market still has to play free, but you need to be able to settle and have the right to be able to settle contracts in gold. So I think that it's still going to be a very, very hard move. I think central banks' holding of gold is not so much because they necessarily see us coming back to a gold standard. They see that in case their fiat currencies lose massive amounts of value, that it's maybe a way to reliquify and give some value back. But I cannot see central banks or governments looking to let go of that fiat power that they have. They want to maintain that fiat money, they want to maintain that ability, but they maybe will use gold to help backstop it. I don't think they'll let it go back to the situation of a completely free gold standard, because that ultimately, that is saying that gold acts as the control mechanism. The real gold standard is central banks do not print paper. It's basically the gold is used interbank to settle. And it's used inter-country, you know, to settle foreign account trade deficits. I just can't see them wanting that handcuff of gold on those international trades and on foreign currency trading, to say ultimately, you know, you settle these into trades with physical gold. I can't see that happening. They may use gold to sort of help boost the value and say, look, we've got all these gold reserves, you know, to sort of give some value to the underlying fiat currency in a real sort of inflationary environment. But yeah, I don't think, unfortunately, we'll get back to a gold standard, certainly not within the next 5 years.
Yeah, I actually really like your description there of a handcuff on what they can do, because that's really what it is. You know, a true gold standard means that central banks can't print their problems or print their way out of economic trouble, which is where we find ourselves now. We have one final question, and we will wrap up after this question, guys. It's come from Kevin. Will silver go down if the rest of the market dips again?
Oh yeah, look, it will, and we got to be honest. Silver is classically referred to as a leverage play on gold. So if gold drops big, you expect silver to drop big and probably more, right? Yep. So you can't get the upside without the downside. If you want that leverage gain, you have to be prepared to wear a bit of volatility in silver. So you know, hopefully you've got those sort of strength of constitution to take the moves. But yeah, silver will correct potentially a little bit more. But I suspect it'll still drop with the gold price, but I think the ratio is going to improve. So let's say that silver is probably going to be, I think for the next few months, certainly maybe a little bit more supportive than gold if the money flows out of both markets. Say silver will drop maybe a little bit less, but I wouldn't be surprised if it does react also violently to the downside. You just have to wear that when you play in the silver market.
Yeah, that comes with the rules there. All right, Bron, we're going to wrap up there. I want to thank you very much for your time. As always, I love sharing your insights with not only my Australian audience, but in this case, the US audience. Thank you for joining us from Sydney, where nobody has COVID there apparently, and we've got it all in Melbourne. And everybody for listening. Thank you very much for joining us in this live interactive session as part of the Sprott Natural Resources Symposium, and I'll see everybody later. Bye, Bron.
Thank you.